to Supreme Success online lectures. My name is Adetono Oluwafemi and I'll be taking financial accounting. This section will be looking at business transaction and source document. Business transaction and source document. By its definition, when we say business transaction, we are referring to the transfer of value from one person to another in terms of money, goods, or services. In terms of money, goods, or services. This is the transfer. When value is created and is being transferred from one person to another, be it money, or goods, or services that are rendered. Put simply, business transactions can be said to be business dealing that exists between two or more persons, wherein values are created and exchanged. The key word here is the creation and the exchange of value that can be measured in monetary terms. Business transactions are important in financial accounting because this is what is being recorded and is being decided upon by users of accounting information. Now we move on to types of business transaction. There are majorly two types of business transaction. Number one, we have cash transaction, and number two, we have credit transaction. Cash transaction and credit transaction. Cash transaction refers to those transactions in which cash is exchanged immediately for goods, which implies that when the person buys a thing, it is the exchange of the thing the person buys is made immediately for cash. And there's an example here: sold goods to Ami, 6,000 naira cash. So when Hami bought the goods, he paid 6,000 naira immediately. So this is an example of cash transaction. In this transaction, there are two accounts that are involved. We have the sales account, and of course, we have the cash account. One is creating value, and the other one is receiving the value. The sales account is the one that is creating the value, is the giver of the value, while the cash account is the receiver of the value. That's why in accounting principle or rules, it is the sales account that will be credited while the cash account will be debited. The second types of business transaction that we have in financial accounting is what we call credit transaction. Credit transaction is the second type of business transaction, and this is a transaction where settlement of money is deferred to a later specific date in the future, even though the goods have been exchanged. Yes, the goods have been exchanged, the ownership of the good have passed from one person to the other, but the monetary value has not been exchanged, which means the transaction is done on credit with the promise to pay at a later date. And these two transactions exist everywhere. You know, when you go to some store or to some business organization, you see some writings on the wall or on a cardboard. They will say, no credit today, come tomorrow. Credit is part of the transaction that is expected to be rendered in an organization. Just that an organization should have a very good way of managing their credit transaction. So credit transaction is when there is a transfer, there's an exchange of goods, an exchange of services without an exchange of money. For example, again, we have purchased goods from Adepimpe, 3,000 on credit. So this is an example. So a person goes and buy goods that is worth 3,000 from Adebimpe, and he did that on credit. So two accounts are also involved in this single transaction, which is a credit types of transaction. We have the purchases account on one side, and we have, of course, the creditors account, which is represented by Adebimpe. Now, we need to note and understand that every transaction creates an account. Every transaction creates an account. At least two accounts are usually created by every transaction. Every transaction creates an account. And by definition, we can say an account is a statement in a double entry system in which are recorded transactions of one specific class which has taken place during a period. I'll take that again. An account is a statement in a double entry form in which are recorded transactions of one specific class which are taking place during a period. At this point, it is important for us to look at the classes of accounts that we have so that we will be able to place the accounts that are involved in transactions correctly. When we know the classes of accounts that we have, that will enable us to be able to identify the accounts that are involved in a transaction and to record them or to post them correctly. And that will take us to what we call accounts. Okay, so now the classification of account, like I said, is important if we will know how to classify accounts that are in a transaction. And it is very important for us to know how accounts are classified so that it will be easy for us to identify accounts in a transaction and to know the exact place where we are going to put those accounts. So here is a diagram, an explicit diagram that helps us to understand what the classification of accounts is all about. Basically, from this diagram, we see that accounts is divided into two major parts. We have the personal account on one part here, and we have the impersonal account on the other aspect. Let's start with the personal account. When we say personal account, we are dealing with accounts that deals with persons, individual, owners, or even managers. Personal account. And under that personal account, we have accounts of debtors, that is receivable account. We have accounts of creditors, that is payable account. We have, of course, capital account, the money that is given by the owners of the organization to the managers for them to run the business. And of course, we also have the bank account, that is the account of the organization itself as a separate legal entity. So this is personal account. I take it again. Personal account, we have the receivable account, that's the debtors, those people that the organization, those people that are owing the organization money, people that buy goods on credit or that do credit transaction. Then we have payable account, that's talking about creditors. Those are the people that the organizations are owing money, people that the organization deals with on credit transactions. Then we have capital account, and of course we have bank account. On the other hand of the account, we have the impersonal account. This account deals with non-person. It is an account that is not dealing with humans. Account that is dealing with things, with materials. They are divided also into two. We have real account and we have nominal account. Under the real account, we have what we call the building, the motor vehicle, the delivery van, the furniture, the equipment, the machinery. In account, we refer to all of these as fixed assets. Assets that are real, assets that can be touched, assets that have value, that last long. They have longer nature of lifespan. And then we come to the nominal account. The nominal account is further divided into three. We have revenue and income. We have expenses or expenditure. And of course, we have intangible asset. Okay, so we have intangible assets, we have expenses, and we have revenue. Under the revenue income, we have sales, we have discount received, we have dividend received. There could be also rent received here, and all the other means through which the organization makes their revenue. And so we also have expenses. Under expenses, we have purchases, goods that are purchased, bought by the organization. Then we have rent that are paid. We have depreciation of assets. And then under intangible assets, we have goodwills, we have trademark, and then we have copyrights. So, going forward, the last aspect we are going to be looking at this section is what we call source document. Source document. And by definition, these are written evidence of business transactions that describe the essential parts of those transactions. The written evidence. For every transaction, there must be a written evidence for us to be able to be sure that those transactions actually takes place. It helps us to prevent issues of fraud and the likes. Okay, so we have source documents which are written evidence that a business transaction actually took place. So when we were looking at the definition of accounting in our previous online class, we said that accounting is the process of collecting financial data. Where do we get those financial data that we are collecting from? We get them from the source document. The source documents are a kind of backup for all the transactions that are carried out in an organization. And for example, we are going to be looking at 7 types of source documents. 7 types. And then the first one we are going to be looking at, which is very common to every one of us, is what we call receipt. Receipt. When people goes to buy anything, you tell them, make sure you come with receipt. What is a receipt? A receipt is an evidence of payment, an ascertainment that there is an exchange of money for the goods that you buy. When you look at a receipt, for example, you will discover that a receipt we have a date of the payment, we have the name of the person that receives the amount that is paid. Of course, it is also used as an information for our cash book, which we are going to be discussing in our subsequent online classes. So the first example of source document that is used in business transaction is what we refer to as the receipt. The receipt. I'm sure all of us have seen a receipt before. I'm sure that one way or the other would have come across a receipt. I would like you to check a receipt and look at the features of what a receipt looks like. The second source document that we are going to be introducing in this section is what we call invoice. Invoice is another source document. What is an invoice? An invoice is a source document that gives complete summary of all the transactions that are being done with a particular person at a particular time. It is a complete summary of all transactions that is being done by a person at a particular time. What are the features of invoice? It shows the quantity of the goods that is purchased. It also shows the price of the goods that is purchased. It shows the discount that is granted to the customer, and it also shows the mode of payment, either cash or through check. Okay, so invoice is another source document that we have. Number 3 source document example is what we call the credit note. Credit note. Usually, a credit note is a document that is used to correct an overcharge. A credit note is used to correct an overcharge, and it is usually sent from the seller to the buyer in order for the seller to be able to correct an overcharge in the amount that is charging the buyer. And then the next one is what we call the debit note. And this debit note is a source document that is used to correct an undercharge. It is also known as supplementary invoice. It is known also as supplementary invoice. This is when the supplier did not charge correctly the amount that a buyer is supposed to pay for a particular goods that he had applied or he had purchased from such a seller. And then number 5, we have statement of account. A statement of account can also be said to be a source document that is sent from the seller to the buyer at regular interval to show all the transactions that are made during that period. It shows all the transactions that are made during that period, and of course the amount that is due. That is for statement of affairs. This statement of account is very, very important in financial accounting reporting. And of course, number 6, we have the petty cash voucher. There is something called the petty cash book, which is a cash book that is used to handle a little amount of money that is used to pay for small expenses. And then we have the petty cash voucher, which is a document that is used to cover small payments for expenses to be credited to the petty cash book. And of course, the last example of such document is a check. We are also familiar with check. A check is an unconditional order in writing that is given by the drawer to the banker to pay on demand a specific sum of money to the named payee. So a check is an unconditional order that is given by the drawer. The owner of an account is giving it to the banker and is asking the banker to pay the person that is holding the check or the named payee a specific price, a specific amount, sum of money to the payee. Now, all of these documents put together are referred to as the source document. And these are the documents that are used in preparing financial informations. Thank you for attending today's online class. Do well to subscribe to our YouTube channel, like and share. God bless you.